I think he'd go to medium level triple digits, like 300 to 500. I know I'm a lunatic. Okay, there's reasons for that, technical and fundamental. But our focus is obviously the long-term technical situation, and it sounds unusual for a market to do something like that, but it's not. There have been instances in the past at other markets, which we've shown in our reports, like in copper in 2005 and 6, and lead in 2007. And I could find tons of others where suddenly a market that's been asleep for decades in a little range says, hey, no more, boom. And it triples, quadruples in price in a matter of several quarters. I consider the war essentially irrelevant to what the metals are doing and have been doing for years. Okay, so anybody who buys gold based on war needs to have their head turned around. I mean, you go back and study the archives. We'll even go back to the Ukraine situation. When was that? March of 2022. You know where gold was then? For several times it had been up over 2,000. After having already doubled from 1,000 in 2015. And in 2022, it was up over 2,000 again, and they bagged it and it went down to 1613 by September of that year, March to September. But that was the war started. As soon as the war started, it went down. Commodities went down. Oil went down. Okay, all the things you'd expect to go up during war, false assumption. In this situation it's not going to drag on for years. Trump may just pull out because he doesn't want to hurt the stock market. He's already done a lot of damage. Whatever, but it's a nuisance headline because it distracts people from the underlying reality, why gold and silver advance in the first place. And the argument for that, monetary argument, silver also has an industrial situation, is simply the degradation of the money units. The yen, the euro, the pound, the dollar, the quantity of those money units, like the dollar, you look at an M2 chart. I go to the Federal Reserve site of St. Louis, look at all their lovely charts. And the M2 chart's like a parabolic, lovely place to be. It looks like a stock market going into blow-off. Okay. And what it does is every decade, basically, if you do the math on it, you can select a point on that chart, like January of 1960, January of 70, and then measure the growth. It's about 80% a decade increase in the supply of money. So no wonder when I was a kid, a loaf of bread was 20 cents. I've said this before. Your granddad, when he built the house, cost $4,500. Your father, $45,000, and now if you want to build a median home price, it's $450,000. Degradation of the money unit. Okay. Now gold, like any market, will inhale and exhale, but basically it's an ongoing process of discounting the ongoing degradation. Now we have a unique situation with driving the monetary metals, and that is they can smell, they know that there are big troubles out there. Government debt. Japan is in a bond crisis. We all know about that. Think, well, that's Japan. Well, yeah, right. It's here too. Our bond market is sick as heck. Even the Fed's been buying it since November. Well, the central government can't afford to have their bonds even be perceived as not being a place to be. And so they've been printing money buying the damn thing. The Fed has. They announced it in November, head of the Fed of New York. Williams said the Fed's going to start buying bonds. His excuse was to provide liquidity. Okay. Anyway, if you look what bonds have done since then, they've gone down in price. Yields have stayed high and gone high. And they're not controlling the long end of the debt market, which is choking. Commercial real estate, consumer credit crisis has been mentioned lately, finally. And MSA, we follow, instead of looking at AI so closely, which will lead the way down ultimately, we're out watching the financials. They don't look good. The financials are anemic compared to the stock market. In fact, if you take XLF, the financial sector ETF, which is full of banks, brokers, insurance companies, credit card companies, and measure it versus the S&P, it's at a multi-decade low in terms of relative pricing status, relative performance. Something's wrong over there. And even some of the big banks, we've been watching half dozen of them since October, and 3 of the biggies have broken long-term momentum structures. Not so apparent on the price chart. And it doesn't mean they're going to crash, nothing like that. I'm just saying that they've broken the kind of factors that we at MSA regard as, negative, big negative. So there's something behind that. And gold knows that. The central bank knows it too. a bunch of ideas to answer that.
Yeah.
Because it's a bunch, and they don't correlate to each other. They just happen to sing the same song. Okay, if you look at a gold chart going back to when they made it legal again in 1975, we've had, that was a peak in gold. It had gone from $35 to 200 before it was legalized. Then it legalized at 200. It dropped in 1976 to just above 100, 50% drop. Between that mid 1976 and 1980, it went up eightfold. Take that bare low price and multiply it times 8. It went up to $850. Okay. And then it leveled off for decades and made a low in 2001, 2002 around 260 and went from 260 to 1920 by 2011. So 10-year bull market, different age, but also an eightfold move. Okay. Then you go to the recent low, the bear low in 2015, 1050. Well, let's say we're going to just match what the other two bull markets did. Eightfold means 8,000 plus gold, just to equal the dimensions of the last one. In fact, what we find interesting, and we've been saying that for a year or so, that's not a target, by the way. That's just saying, hey, just to match the prior two, do it again. JP Morgan came out with a number like above 1900 as a fundamental target. That was interesting. Above 9,000. So even above the 8,000 level. So, but silver during all that time, 50 years, was capped at 50, 50, 50. Yet gold would blast out the highs. Silver would go up with gold, but it wouldn't get past the 50 level. Well, that changed. And we anticipated that it would. 2024, we said silver at $26, primary buy. And then in June 25, silver pushing toward 35, we said accelerations to begin. And our last buy signal, and it will be our last primary, was November last year when silver was 56. Because at that point, silver broke out versus gold on a relative performance basis, a technical basis, saying, hey, I'm going to beat you. I've been lagging you. I'm going to beat you now. And since then, well, you can see what silver's done. It was $56 in November. And yeah, right now it was 73 on Thursday, yesterday, in a pullback. But as far as the war news, again, that occurred in early March, and silver was above 90 then. But the real collapse in silver came one day at the very end of January, where you dropped down into the 60s by the first trading day of February. So a day and a half drop, you had the full drop. The only thing silver's done since then was after rallying back up to 90 plus early this month. Then the war hit. You're right. It sold off instead of going up like people think it should, which it doesn't. They don't follow war. War is not a fundamental for gold and silver. And it came down and nipped out 2 weeks ago. We took out the February low, which is for silver like 66 something. We get down to 61.20 and immediately rocketed back up into this mid 70s. Like, ho, fooled you. Okay, take it out to February low. Gold did the same thing. Got down to February low was $4,223, I think. We went down and swept that, got to 4,100. And 2 hours later, we'd rallied hundreds of dollars after taking out that low. And gold's now, we've hit 48,000 last week, 4,800, last week. And I think we settled about 47, something like that. Anyway, but war is not an issue. And most of the damage, the war sell-off was merely within the context of the already drop that had occurred in late January, if you get my point. It's going to take a lot to cut the demand side because the solar demand for silver is extraordinary. And, China produces most of the solar cells and photovoltaic cells that go in the solar panels, like 90% of global production of that. And it's in great demand, particularly as oil goes up. And by the way, oil going up does not hurt the monetary metals. There have been plenty of times when oil has exploded and monetary metals have exploded during recession as well. Okay, late 70s. Okay, people say, well, if you have higher oil prices, that is going to cause a recession. Therefore, that'll cause gold and silver to go down. No, the central banks go ape when you enter a recession. And the money never flows to where they want it to go, which is the stock market bubble that is already breaking, and therefore the bad data points that they're trying to save us from. The money flows elsewhere, and it's almost always gold and silver. Used to be T-bonds, too. Not anymore. So you're left with one alternative right now. So that's as far as the global issue of oil prices. Oil is still cheap at 100 plus. Look at its old highs. Go back, 2008, 2022 and so forth, 150, 140, 130, that kind of thing. So gold at 110 is just sort of getting up to the old nominal price highs. Remember the degradation of the money unit. If you degrade the money unit by 80% a decade in terms of increasing its quantity over time, then the price is something that decades ago, if you factored in the monetary degradation, should be quite a bit higher just to reflect the decay and piece of paper you're using to measure it by. Gold does that, and oil has done that. Silver is now finally doing that. But no, I don't think oil is going to cause a recession. We think there's a recession or worse coming anyway, and we think that's been built into the factors. And it's a stock market bubble that we're sitting on and looking at. And if you want to know why we have a stock market bubble, look at an M2 chart and then look at a Fed funds rate chart. Going back 3/4 of a century, you can get one on the Fed side of St. Louis, get a M2 chart and a Fed funds rate chart. And even with the rate rises that we've seen since 2009, where 10 of those years was zero rates, and then they had some rises up to like 5%, okay? Even that level is dirt cheap, historically speaking, if you go back and look at 75 years of Fed funds. So the Fed has kept money cheap and almost free for 16 years or so. And therefore, it's a drug-induced bull market because you've got